Hello, everyone. It's Nick Kyprianou, President and CEO of RiverRock Mortgage Investment Corporation. I'm going to give a slight recap of 2021 and then talk about what we think is going to happen in 2022. 2021 was obviously a very busy year for RiverRock as well as other lenders out there. We had an exceptional year, our best year ever. Very positive news was our arrears at the end of December 2021 was 0.01. That's lower than the bank's arrears rate. And that's due in part to our extensive due diligence on real estate and then our administrative side on the communicating with clients. We're very proactive and we get on top of things very quickly. Since the company started 8 years ago, we've had 0 losses, and we believe that trend will continue due to our extensive and proprietary underwriting model that we have in place. Now, going into 2022, it's going to be an interesting year. It's a little bit slower to start. We're having a record January for RiverRock, but there is a substantial number of decreased listings out there, partly because of the weather, partly because people were wondering what was going to happen with rates. But we think that listings will start to pick up in the next 60 days or so. There will be rate increases this year. We believe that the first one will happen in March, end of March, beginning of April. We think that there's going to be about 4 rate increases this year, which will move 100 basis points, the rates up 100 basis points. So, you're probably wondering, who does this affect? So this would affect not as much as you think. So for example, to qualify for a bank mortgage today, everybody has to go through the stress test. So when people apply for a mortgage, they have to qualify at a rate of 5.3%. So even though over the last year or so, they've been getting 2.5% for a 5-year fixed or as low as 1.5% on a 5-year variable, these people have qualified for a 5.3% rate. So I think the interest rate shock that people are talking about isn't going to have that much of an effect on people as much as you think. Now, there is a portion of people that have a variable rate mortgage, and that rate will increase with each time, and these people could be stretched a bit. But as I always say, there's a hierarchy of debt. So people's homes are at the top of the pyramid, right? That's the highest, that's the most valuable asset they have. That's the thing they deal with first, and everything else is secondary. So, you might see some credit deterioration out there with respects to loans and credit cards, but I believe you won't see that much with respects to housing. Because people will prioritize and not let that slip. They might let some other things slip if they get caught into a variable rate crunch in the end of 12 months. But like I said, people have qualified at 5.3. So, all the numbers were in place when they got the mortgage. Now, with respects to values, as everybody's aware, everybody saw a pretty big increase in values last year. We see the first half of the year's values going up a bit just because there's a big supply and demand issue. But I do see the second half of the year values kind of leveling off. There might even be some pockets that got a little overheated, backing off a little bit. There's 2 components of this. One is, rates will have an effect on new purchasers. And then the other effect will be affordability. So even if they don't touch rates, eventually, as values keep going up, it becomes unaffordable for people. So the market will just naturally start to simmer down just because of the price and the value and because of affordability. So regardless of what the rates are, values hit a point where it just becomes unaffordable. So I think it's getting to a point where it's getting close to that stretch part. There's 2 things that will happen that will ease on that. One is, we need to let people catch up income wise to afford those mortgages, and incomes are increasing out there. And then the other component is immigration, right? The Canadian government's committed to 400,000 new immigrants a year. the type of immigrants that come into Canada today aren't like the immigrants of the 50s and 60s who came here with a strong work ethic, but not a lot of education and no money. The immigrants that come to Canada today have a lot of education and they come with cash. So they can hit the market relatively fast. And a lot of these people, you know, were in other countries such as the UK and the States, and when they like in high priced areas like New York, San Francisco, and other European places that are very expensive, and they come here and they go, well, these prices aren't that bad. I know to us, you know, because we've been watching this happen, prices seem a little bit crazy, but if you're, you know, in the UK, or if you're in San Francisco or some other countries in Europe, these prices don't seem that bad. And if you've got the cash and you've got the income, it's all about payments, right? The other advantage at these rates, even with the rates going up 100 basis points, every payment you make, 52% approximately, comes right off the principal. So that these homeowners are creating real equity in their homes. If they're paying $1,000 a month in a mortgage payment, $520 is hitting that principal every month. So they're creating equity in their homes, which they can use if they do run into a crunch down the road for one reason or another. So I think that values will go up a bit in the first half just because of supply and demand. There's big supply, not enough demand. The rate increases will start to mentally have an effect on people. Psychologically, they have effect on people. And then the second part is affordability. That will also have effect, because as the rates go up, the stress testing rate, as I mentioned earlier, is at 5.3% today. That will also increase. So people will have to qualify for that rate. But I'm not seeing, you know, employment is very strong. Unemployment numbers are back down to pre-pandemic levels. As things open up more and more, things will start to normalize and people will get back to business and get going again. New businesses will start, restaurants will start to make money, and so forth. So I'm always cautiously optimistic. We still focus on urban, suburban areas. In Ontario, we don't lend on rural properties. We don't lend in small towns. We read a lot of the data on real estate in all markets across the province, and what a good indication is when markets soften, when real estate markets soften in the residential side of things, what you start to see is the outer areas, the rural areas, the smaller towns in the province start to have the effect first. Those values start to drop, and then it works its way towards the city. So you know that when things are softening, because those outlying areas start to show softness. Just in the reverse, when the market starts to heat up, it generally starts with the GTA and works its way outward. So by watching all these numbers all the time, you pretty much get a sense of what's going to happen. Now, currently, we're not seeing any of that softening in any of these areas. But like I said, in the second half of the year, we think that there could be a leveling off. So we stay very diligent on our real estate evaluations. We look at our exit strategy on every single mortgage we approve, because if we don't see a clear path to getting out, we don't do it. And as I said, 93% of the book is owner occupied, and the rest are rentals, but they're all highly marketable properties. Our average 80% of the book right now is in first mortgages. The rest are in seconds. Our average loan to values around 69%. So we think we're well poised for anything that could potentially happen. But like I said, we're cautiously optimistic for this year, and we think immigration will kind of keep things going. And just watching the rates, the rates have more of a psychological issue than anything else. So we just keep watching and play conservative, and don't get distracted. Like, that's the key to this business. It's a business about discipline. So that's what we're thinking about 2022. Thanks to everybody that is invested in RiverRock. And if you have any questions, reach out to your 9-point sales representative, and they can set up a meeting, or with me and them, or you can, and they could be answering most of your questions if you have any. So thanks very much, and good luck, everybody, and keep safe out there. Thanks very much. Have a great day.